From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, price pressures remain hot as two inflation forecasts top expectations, and the data shifting from market expectations for a Fed rate cut to the summer. And amid all of this, it's a record start for the year for high-grade issuance. But we begin with the big issue. The data changes the game.
We're just getting a lot of noisy data.
The totality of the data and the mosaic of the data.
These little ripples and waves of inflation coming back.
It emboldens the Fed's patient stance.
Add that to the CPI data that we got early this week.
The number was a bit hot.
They're scratching their heads in a number of places in the Fed saying the economy is not responding to interest rates.
The Fed is not going to make a decision based on one data point.
I wouldn't necessarily read so much into this.
All fits within this bigger context.
The Fed will not be cutting rates as much as the market expected.
We only have 3 rate cuts this year.
3, maybe 4 cuts.
I think the first rate cut is in June.
Late this spring or in the summer.
We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
I want to start here with a look at that inflation data, CPI and PPI falling but topping estimates. Take a look at just how far we've come with producer prices coming down here in the yellow and the consumer prices. But we are talking about that last mile of inflation here now, and we do have a way still to go, plus some hiccups along the way, now sending yields shooting higher. We're looking at the 2-year right now around 4.67, the highest levels of the year after investors have gotten surprised with data coming in higher than expected. This pink line here, the Fed's preferred gauge of inflation, we are still waiting for that data to come in for the month at the end of February, so keep an eye on that. And in the meantime, with those bonds moving, I want to flip up the board here and talk about just how bond investors have fared with the inflation whipsaw that we've been seeing, because the global ag index has given up most of its gains from December when the markets thought the Fed would cut earlier this year. Now just take a look at that. It had looked so rosy at the beginning of December. We have even turned negative for a moment here in February. We are barely looking at gains here since that bond rally really began. And when you speak of the Fed, Atlanta Fed President Raphael Bostic said that there's no rush to cut rates. And in a speech last night, he said that the evidence from data, our surveys and our outreach says that the victory is not clearly in hand. And it leaves me not yet comfortable that inflation is inexorably declining to our 2% objective. And joining us now to talk about this is Steve Brown of Guggenheim Partners Investment Management and Karissa McDonough of Community Bank. Steve, when you looked at the inflation data coming out this week and just this morning, did it concern you much?
We're not trying to get too caught up in the month-to-month variation in the data. We acknowledge that there's likely to be some seasonality issues, particularly as we're starting the year. What we like to do is zoom out, as you did on that first chart, and look at the direction of travel. The important thing is that inflation is coming more in line with where the Fed wants it to be. And even more importantly, the Fed over the last 3 months, since you showed that recent bond market rally, introduced the idea that they can do insurance cuts or cut before they're at target. So to us, it's more about the direction of travel, and we're not trying to trade around the day-to-day to month-to-month, but expect continued volatility. But you have really high yields to compensate you for that volatility. So we think it's a good time to be investing.
Karissa, what does the inflation data say to you, and do you worry about a reacceleration of inflation at this point?
Thanks so much. We are actually not super concerned about a wholesale reinflation acceleration. And the reason being, a lot of the persistency that we've seen has been in the services data. We actually think that's a bit of a catch up from, kind of coming back from COVID and a normalization. So we actually expect, a lot along the lines of what Steve said, this is a really good time to be looking at long dated bonds. The Fed, again, is not going to be hung up on any 1 or 2 inflation prints. We know that the data has been incredibly mixed. We saw very weak retail sales, factory orders. So a couple of inflation prints, while they're concerning, they're going to be taken kind of the broader context. So we don't think that we're headed for higher inflation at this point.
Steve, what do you do when you see a bond sell-off like this? So, we've definitely seen a significant move from 447 at the beginning of the week on the 2-year to 467. That is 20 basis points. I mean, do you see these as buying opportunities, or does that volatility worry you?
It doesn't worry us on a day-to-day. We're thinking about the current environment much like last year in that it's range-bound. So we believe we're at the upper end of ranges for yields, particularly as you cited for the 2-year part of the curve. What you want to do is look out to what Fed expectations are for the terminal rate. And so now with the recent backup in yields, we see the terminal rate the market's expecting is closer to 4 or in the high 3s. Frankly, we think that's a buying opportunity because the Fed themselves likely think that they're going to get back into the 2s. We're more in the low 3s camp, but we've overshot the recent ranges. And so we would be tactically adding within these range-bound yields that we're expecting for the year. And importantly, carry should ultimately win out. Last year was a year where you saw a lot of volatility under the surface, but when you zoom out, interest rates were essentially unchanged on the year. Now we're in an expectation where you could have rates higher for an interim period, but on balance, we think they should be generally flat or biased to move lower.
Karissa, how do you feel about positioning further out on the curve at this point?
This is an excellent opportunity to do so. Anytime we see a sell-off, we are adding on the long end of the curve. We're looking at 10-year yields in excess of 4.20, 4.25. Absolutely an opportunity, especially when you're comparing it, as has been talked about, the expected long-term or terminal rate. We think that a more normalized area would be in the 3.5% for long-term rates as we go through a market cycle. So this is completely the time to be adding duration. There's a lot of different portfolio strategies that you can engage in that would benefit from long duration. We are putting our clients into long duration anywhere possible. This is absolutely a great opportunity. I cannot emphasize that enough.
Wow. So Steve, do you feel the same way about duration, and how far out would you go?
So we partially agree. So our bias when we are adding duration is more towards the belly of the curve. Again, we think in an easing cycle, that's the part of the curve that tends to outperform. But we're primarily credit investors. So we're trying to add excess return through credit selection and sector allocation decisions. And so when we talk about credit, we do think we're in a good environment right now. While valuations are not as cheap as they were, say, 3 or 6 months ago, when you look at the all-in yields, the baseline yield plus the spread, you still have a lot of total return opportunity and a significant amount of income. You can generate portfolios that are diversified in high-grade assets and getting yields anywhere from 6 to 8%. And if you want to take more risk, you can go and get 8 to 10%. So this is really an attractive time to be a fixed income investor.
Well, Steve, what do you prefer here? Do you prefer duration risk at this point or credit risk?
Credit risk. Duration risk is going to have a lot more noise and volatility to it. We would like to have some of these biases put into our portfolios and strategies where we can. But duration's been a low Sharpe ratio or volatility adjusted excess return tool over the last couple of years. While we agree with Karissa in that rates are biased to move lower, we think a combination of relatively safer, higher credit quality, longer duration instruments, while taking a little bit more credit risk and generating a lot of carry in the intermediate and front end of the curve is the right portfolio balance. Because what we don't want to be doing is taking a lot of additional fundamental credit risk in this environment. It's going to be a security selectors environment, but that's one where active managers should be able to prove their worth.
Karissa, how do you think about the rate cut environment moving forward? You've seen just this week a rapid repricing of expectations in swaps markets. Does it matter to you if the Fed is cutting 4, 3, or 2 times this year? What's the biggest difference that would make in your portfolio at this point?
I think the general direction is more important than the magnitude. And to the degree that we see that the Fed is continuing to have that bias to either hold or start to stair step down, like we said at the outset, a couple of cuts have now been priced out for this year. So we think the Fed's going to possibly look at June, take a break, look at the data, go to July. But again, I think the more important thing is that the absolute direction remains down rather than kind of magnitude or speed at which that they're cutting rates. And I want to go back to something that Steve had said on the credit side. We also agree that credit represents opportunity. You do have to be somewhat careful. We really like the bank space at this point. A lot of bank, like single A kind of holdco bonds are pricing in more systemic risk. We don't think that's accurate. We think there's some balance sheet issues possibly for some issuers, but that represents opportunity in kind of the bigger, safer names. So that's one place that we're also seeing value at this point.
You know, Steve, it's worth asking, too. There's been so many fixed income investors really waiting for the year of the bond to really start paying off.
Right.
And you see some of the losses that are sustained in some asset classes here in fixed income. What are the biggest risks to you at this point?
Well, I mean, I think a continuation of volatility intraday, intramonth, introduces sentiment risk. Fixed income markets have broadly benefited from positive flows to start the year and in the back half of last year, and we think that'll broadly continue. So, the direction of travel is very important. Of course, there are risks broadly across the markets. The longer interest rates stay higher, if we can acknowledge that they're relatively high now, the totality of the move in rates will start to catch up with some lower quality issuers. And so just being selective is the best way to be allocating amongst credit right now, and acknowledging that not all issuers are the same, not all sectors are the same, and this is really where you need to be prudent in your credit selection, particularly given all the uncertainty, which is unlikely to abate. Think about a period where we're going to have less volatility in data or markets. It seems unlikely that we will square to that type of environment, so you have to be flexible.
We have to leave it there. Our thanks to Guggenheim, Steve Brown, and Karissa McDonough of Community Bank. Now up next, the auction block. It was a stunning week. Bristol-Myers saw a massive order book for its bond issuance, as issuance still remains hot. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block. Issuance stays hot. U.S. high grade is off to the fastest start to a year on record. And it was another active week for over $37 billion in sales, pushing volume 16% over where we were for the same time in 2023. There were some big names with sales like Intel, BNP, and Bristol-Myers. And I want to dig into Bristol more because it was a massive sale of $13 billion of bonds to help finance acquisitions. The deal gathered orders exceeding $85 billion, and it was the biggest offering since Pfizer in May of last year. And in U.S. high yield, almost $8 billion priced this week, with Monday seeing more than $6 billion, making it the busiest day for supply since April. And so far this month, the total supply is almost $19 billion, up more than 30% from the full February of last year. Rob Waldner of Invesco weighing in on the current environment for credit.
There is a basic conundrum here, right, which is that the macro backdrop is very positive. So steady growth, disinflation, Fed moving towards cuts. The technicals in credit are very strong. There's tremendous demand for credit in our view. But you point out valuations are very tight. We're 10 basis points off the GFC tights for investment grade credit spreads. What matters to end investors is the all-in yield.
Joining us now is Kelly Burton of Barings and Chris Long of Palmer Square Capital Management. Kelly, when you look at the direction of travel here, we were talking about the broader market, this idea of interest rates perhaps staying higher for longer. What are the ripple effects for that into credit markets?
Yes, for the world of high yield, which I live and breathe every day, we're actually a shorter duration asset class than that of something like investment grade. In fact, we're about half the effective duration when you look at triple Bs versus the U.S. high yield market. So while we still think we're going on the other side of the rate story and it should be going down this year, that will be somewhat of a tailwind. Our duration keeps us somewhat protected on those massive moves and when we see real pockets of volatility. So we can kind of really generate solid returns regardless of the rate story.
How do you feel, Chris, about the impacts that these higher rates could have in terms of credit quality starting to deteriorate?
I think a higher borrowing costs, on a continued basis, obviously has to be something that investors consider. And you look at things like interest coverage ratios and sort of, corporate credit metrics that are important for debt service, that's something people need to be mindful for. And that I tend to think that higher for longer is certainly something that's going to continue and persist for quite some time.
Kelly, do you think that some borrowers will certainly start to see more pain? And if not more pain, then will they start to meet more resistance from that investor in high yield that has been really excited about the space more recently?
Yeah, fortunately, issuers over the past couple years, as you know, didn't really have to tap our markets because they had already termed out their debt in those periods of low rates. Now that story is changing, certainly. We've got 25% of our market that is coming due over the next 3 years. But we're frankly here looking at the maturity wall now as more of an opportunity than a threat. Half of the amount that's coming due is actually very solid BB rated paper. And because the market has really officially reopened to issuers this year, we've even seen CCC rated, low B rated issuers successfully tap the market. It might be at higher coupons than they were able to have in their prior capital structures, but as long as they're able to service the debt and the interest cost, then it can still work very much for high yield.
Well, what about spreads here in the high yield market? Kelly, do you think that investors are feeling like they're getting compensated? I know that there's a push-pull between what you're getting in terms of the spread versus the yields you're getting on these new issues, especially.
No, you're right on the valuation argument. You can't ignore that spreads are historically tight. But I think why the asset class is still attracting folks in, it's really 3 reasons. You've got absolute low dollar prices still. We're sitting in the low $90 context. So that's offering some nice pull to par stories, which doesn't generally happen in the world of high yield outside of recessionary environments. You also have that short duration aspect that really ties into that. And so if we're able to buy a bond at 92 cents on the dollar and we have good visibility into their potential to refinance that debt in the next couple of years, then we're going to march that right up to par and really lock in some nice realized gains. And then beyond that, yields outright are still pretty elevated at around 8%. Last year, I was on the show in the fall, and we were getting closer to 9% at the time. And over the past year, anytime we gapped out that wide, that was a very strong buy signal for people to really pile in. But 8%, it's still pretty good and it works.
You know, it's interesting, Kelly, Chris, there's a lot of conversation around risky to riskier. And Chris, I'm wondering how you're seeing the syndicated and leveraged loan market in a moment when there are a lot of people pushing for a rebound of the market.
Yeah, we see a lot of activity. We actually believe the market's incredibly healthy. I think you look at it from a total return perspective, there's a lot of opportunity. And for us, where we focus, which is on the larger company and think, $1 billion plus term loans, I mean, that's a place where the resiliency and the credit metrics are equally strong. So we feel very good about that area. And activity is absolutely picking up. You're seeing possibility and talk of a lot more M&A. There's certainly refinancings coming as people want to get ahead of the maturity wall. And then lastly, there's a lot of strategic activity. So we think it's a good value to be in the syndicated loan market as we speak.
But even in the syndicated loan market, it's interesting you say you're focusing on kind of the bigger issuers here, because even in equity markets, there's a lot of question about if there is more inflation, higher than expected inflation, or even reaccelerating inflation, how do the smaller to mid-sized companies fare? Do you avoid that space because of that worry, Chris?
We do. There's a few things. Obviously, from a larger company perspective, we believe that's a higher quality bent for us. We believe in better management teams. We're also, to your point, Sonali, we're overweight non-cyclicals. So we're trying to take a little of that equation out, even on the larger cap end. The smaller mid cap, there's less ways to finance themselves. There's a lot of concern about, honestly, interest coverage ratios being too low, kind of 1 to 1.5 times. I mean, so I think you have a higher quality opportunity in that larger end of the market.
Kelly, talking about sectors here, are there areas that investors are concerned about in this environment in particular in investing in?
Yeah, I would say in global high yield, some of the pockets of weakness have really come out of the media space. One segment of the market we've quite liked is some of those legacy wireline credits that have been deploying capital into fiber, But that's coming at the expense of, for example, legacy cable providers. So we are monitoring that very closely. And within that media space too, while they should benefit from political advertising revenue this year, there are some secular concerns there as well. And then certainly on some of the tech names that were more of the LBO activity that came with high levels of leverage, maybe low B rated, where you have CCC downgrade risk, that's where we have been somewhat wary.
Kelly Burton of Barings and Chris Long of Palmer Square Capital Management, thank you for helping us navigate a very complicated environment out there. Now, still ahead, the final spread, the week ahead. Big box earnings are kicking off, Fed speak, and more. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the week ahead. Coming up Monday, U.S. markets are closed for President's Day, but Tuesday, we're going to get earnings from Home Depot, Walmart, and more. Wednesday brings January's Fed minutes, plus NVIDIA earnings. And on Thursday, we'll get another round of jobless claims, plus the ECB minutes as well. And on top of those Fed minutes, we're going to get more Fed speak through the week. Philip Jefferson, Michelle Bowman, Patrick Harker, Lisa Cook, Neil Kashkari, Christopher Waller, and more. Remember, we had a lot of economic data this week. Now it's going to be a matter of what the governors and the presidents all feel about what this means for the pace of rate cuts. Of course, we've had a lot of volatility this week. We have had a stunning 20 basis point move from close on Monday to midday today, passing way past that 460 level in that 2-year yield. So next week, we'll see if that level sustains when we hear from those commentary as well as from those Fed minutes. We'll keep an eye on all of that and more coming up next week. We'll also have a lot of those earnings that will give a sense of the strength of the consumer, as we've seen from the other economic data this week, those retail sales and that UMich consumer sentiment data that we've seen just this morning. Quick check on the markets before we let you go here. The 10-year yield also facing that 8 basis point move here, up at 431 on the day. A popular trade for a 2-year yield, as I've been saying, at 467 on the week. Now from New York, that does it from us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.